That's the positive side of hyperinflation. It stops people from killing each other eventually because they run out of money to do so. It's, a morbid thought, but it's true.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 29th through August 5th, 2024, while supplies last. First, we feature Dealer's Choice Constitutional Silver Dimes, quarters, and half dollars at $2.50 over spot per ounce. We also have 1 ounce gold backdated Canadian maples at $65 over spot. Next, we have a limited quantity of 1 ounce silver full color Trump Fight for America bars at $6 over spot. They come 22 a sheet and so have a minimum order of 20. And finally, we have 1 10th ounce gold backdated American Eagles at $39 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Rafi Farber from the Endgame Investor. Rafi, thank you so much for joining us today.
Thanks for having me on again, Elijah. Good to be back as always.
Well, it's great to have you today. I did want to start off with the discussion on the banking system. Now, you recently have been reporting on this and put out a video saying that really bank reserves, and this was kind of a realization that just came to you, that bank reserves are the ghost of bad debt. Can you expand on why you think that?
Well, I think literally it's easy to demonstrate. Literally, that's what they are. I mean, if you go back in time to 2008, right? You see on the balance sheet that the balance sheet expanded from whatever it was. It expanded about $800 billion in a few weeks at the beginning of the 2008 financial crisis. And at the same time, reserves went from just a couple billion, I don't know, was it 10 billion like that, to about 800 billion reserves. So what actually happened was that all this debt couldn't be paid at the same time, whether it was commercial paper, long-term debt, short-term, everything was just dominoing into the next thing. So nothing could be paid. So what the Fed offered to do was said, all that bad debt that can't be paid, look, we'll pay for it and we'll give you reserves. So the banks ended up holding on to these reserves, and all that garbage is on the Fed's balance sheet. And now from about 2008 to 2020, the Fed called this stuff excess reserves because they're supposed to keep a certain amount of reserve on the system, right? To pay emergencies or for recessions and withdrawals and stuff like that. But now they had excess reserves. So then in 2020, they stopped calling it excess reserves because it got just too out of hand. Because in 2020, they printed another 3 trillion of the stuff, but all that other debt couldn't be paid because they had frozen the entire economy for reasons that we all know why, and we won't get into. So that debt couldn't be paid, and all of a sudden reserves are like wham, because they said we'll take all that stuff and we'll give you just dollars, and you'll keep it on your balance sheet. So all the dead debt that could never be paid back is still there. It's just in the form of something called reserves. And what do the banks do with this stuff? And from here, I guess we'll segue into the next question. What do they do with it? They trade it between each other. It's not like every bank has these. Very few banks have any excess reserves. It's the very big banks like JP Morgan and Bank of America, and what's the other one? I don't know, Wells Fargo. What are the big ones? They're the ones that have the excess. And the other regional banks, the smaller banks, don't have any excess. So they have to borrow from the repo market. And the other excess goes to doing repo loans for emergency, closing their books with regulatory standards. So the big banks are earning a lot of interest on these repo loans that they use reserves to make extra money on. And they don't really go into the economy. They're just shuffled between banks. That's it.
I think it's interesting to take a step back here, because I remember back probably almost a decade ago when the Federal Reserve was doing a lot of QE and they were essentially buying mortgage-backed securities off of banks' balance sheets. A former Fed official actually called that a backdoor Wall Street bailout. And you can definitely see why he would think that is essentially, these toxic assets are being bought off these banks' balance sheets, and is just being replaced with cash. So it's really interesting how you say, bank reserves are the ghost of bad debt. I mean, it really is. It seems like kind of just a backdoor bailout from the Fed here.
Yeah, you could even say it's a front door bailout. Why back door? It was so obvious. I mean, it was less obvious to us in 2008, but now we know how it works. It's like it was never as blatant as it was in 2008. It got even more blatant in 2020. And the interesting thing is like, okay, so if it's the ghost of bad debt, why don't you just erase it? Well, because now you have all these banks dependent on these reserves to close their books every night in the repo market, and repos these overnight loans between banks, really from the big banks to the small banks. So the small banks don't have the cash, and the big banks have all the reserves. They become addicted to it. So if these reserves go below a certain threshold, you have what's called the apocalypse, which we're all familiar with from 2019. So the ghosts in the system have to stay in the system, or the system crashes. And so really there is no way of getting rid of all this debt. You have to keep the ghost of it on the balance sheet, or else everything falls over. You know what? Eventually everything is going to fall over, either officially because the Fed's going to say, no, we're not doing it anymore, which is not going to happen, or the public is going to say, look, all those reserves in your banking system, I don't want them anymore. Give me real money. So that once that happens quickly. It hasn't happened yet, but with the world as unstable and scary as it is right now, it could happen pretty quickly once confidence is lost.
No, when it comes to bank reserves and what we're seeing right now, the big banks, as you mentioned, if they run out of excess reserves, that could be a huge issue for the larger banking system, because they might, if we see regional banks starting to fail, then if they don't have any excess reserves from the big banks to tap into, that could be an issue. Can you expand on what you see happening in the banking system going forward?
Yeah, well, if you look at a graph, and you can look at this yourself, at the Fred, the St. Louis Fed has these charts, right? It's called Fred. So if you Google Fred SOFR volume, right, you'll see that this is the amount of reserves that are trading between banks every night. And since 2021, I believe, early 2021, they've gone up and up and up and up. And they went from like less than $1 trillion to now 2.1, 2.2 trillion last night. A new record. And almost every night there's a new record. It kind of zigzags, but it zigzags up. So I think right now they're right near 2.2 trillion. But like these are not, it's not the fountain of youth. It's not an everlasting gobstopper. I mean, they're taking these reserves from somewhere. They're taking it from their reserve balances, right? Which you can see it's the other side of the dead debt again. That's on the Fed's balance sheet. And once the reason you can never get rid of it is that, let's say a mortgage-backed security that the Fed bought in 2008, right? Now it's 2023. Let's say they bought it in 2008 and it had 15, 16 years maturity until it was matured. So now all that money's owed back to the Fed. So the Fed gets the dollars from the banking system. Whoever pays it doesn't make a difference, right? And then that money goes away back into the Fed, into the black hole of the Fed. And then there's fewer reserves in the system, but if there's fewer reserves in the system and the SOFR volume, the repo volume keeps going up, well, eventually you're going to hit something where you don't have enough dollars to satisfy all the daily repos that are happening every night. And then what happens then? We know what happens then. What happens then is that overnight interest rates go up to 10%. And everyone's like, oh my gosh, we have to print again. Blah, blah, blah. So that's going to happen. Exactly when, I don't know what's going to happen. But the last time, I have a heuristic that might work out. Again, like this is not anyone has a doctorate in, so nobody really knows. But when the repocalypse hit, I did the calculations, and what we saw was that repos were taking up 87% of the available bank reserves, of the available ghost of dead debt. So my theory is that once we hit 87% or somewhere around there, it could be less, could be a little bit more, something like that, then there's going to be another problem in the plumbing, and the Fed's going to have to print the missing reserves and buy something else, buy some more crap dead debt. the next marginally dead debt it's going to have to buy. The question is how much damage is going to be done before they can pull that trigger again. And I don't know. So right now we're at about 66%. So when we get to 86, 87%, it could trigger it, and that could be in a matter of months.
Now, there is also a sign from another place, obviously, in the financial system that is showing that there could be a crisis coming in the future. The dollar base, you've said, is shrinking right now, and obviously deflation it would be a sign of a financial crisis. So can you expand on what is happening with the monetary base right now?
The monetary base is very similar to reserves, not exactly the same. So the monetary base, it shrinks as quantitative tightening continues, and quantitative tightening is continuing. It's continuing at a slower pace. That's basically when the Fed has interest-bearing assets on its balance sheet. And so when whoever owes the money, whether it's a mortgage or a treasury, pays that security, the money goes ultimately to the Fed, and then it goes out of existence and the monetary base shrinks. The monetary base is the base of the dollar pyramid upon which all other debt is built. So when you hear people say that every dollar that exists is ultimately owed back to the Fed, well, that's what they mean. Because how are these dollars brought into existence? They're brought into existence as the Fed buys the debt and then hands out the dollars to the banking system. And so ultimately, whoever's spending it, it shuffles around and goes from party to party to party until ultimately somebody has to pay back the debt that the Fed ultimately bought, and then the monetary base shrinks. So as the base shrinks, the reserves will shrink. As the reserves will shrink, we get closer and closer to some kind of not inflection point, but contact point. Say crash. I forgot my English, but you know what I'm saying. And it's going to come. It's going to come, I think, somewhere around $3 trillion, because that's where the regional banking crisis hit. So 3 trillion, we're at 3.27 right now, and it zigs up and down, and the trend has been down for about 5 months now.
Now, how is this going to impact the average person if they think of their day-to-day life as we see this banking crisis and this deflation? What does it really look like in their life at that point?
It's not clear if there's going to be much of an effect immediately. What I would worry about as an everyday average guy is that one of these crashes or one of these crises is going to spur a much larger avalanche in debt that the Fed is going to have to print much, much, much more. So, we saw in the regional banking crisis, it didn't really affect anyone unless you were a shareholder of Silicon Valley Bank, because the Fed was able to assure everyone that they didn't have to take all their money out and they were going to bail everything out. And the QE that they embarked on, it was only a few $100 billion. Only a few $100 billion is the numbers that we're used to saying these days. So it could be another one of those, but I don't think so. I don't think it's going to be, and I think it's going to be much bigger, like 2020, but times 2 or 3, right? Because 2020 was times 2 or 3. 2008 was much more times 2 or 3 than 2001. It keeps going in that direction. So if you're an average guy or gal, what I would be watching for is if the Fed has to print, let's say 7, 8, 9 trillion in reserves in a week, then you could really start to see a panic in the dollar, and you'll need your physical gold and silver and your food for like a month or two, or however long it's going to take for things to calm down. You don't want to be in bread lines. So, just watch out for that. If it's going to be another size, 2020 in size, then you probably got a few weeks to a few months to get your monetary affairs in order, let's say.
It is interesting because with 2020, it was kind of almost a self-imposed lockdown, right? Things still functioned for the most part. You could still go to the grocery store and most of the items were still there and the currency still functioned, right? But it seems like this end game that you're envisioning is where the currency kind of shuts down. And I know we've talked to Bill Holter about this, and he says that, just like a loaf of bread, right? There might be a dozen or so transactions from, the farm to actually you purchasing it. And if any of those currency transactions don't work, the complete supply chain doesn't function. So it seems like much worse than a 2020 or the COVID era that we could be seeing in the future.
Yeah, we're definitely going to be seeing that. The point is, we don't know if the next monetary hiccup is going to be an earthquake or just going to be a little cough. Like 2023 was a cough, and we thought maybe it was going to be the thing. Maybe it was going to be the big one, but it wasn't. In 2020, I knew it was going to be big. I wasn't sure if it was going to be the last thing. But I'm getting a feeling that maybe it's because I'm on the front lines of this thing on the Lebanese border, that things are starting to get out of hand, at least geopolitically, and that's the front end of the rotting monetary system. The monetary system is the back end of what's going on politically. It always happens that way. So, I don't. The way that things are going on, and on the sort of corollary to that is that most of the countries that are involved in the big conflicts, like Lebanon, Iran, Syria, none of them have functional currencies. None of them. They all use the dollar because their currencies have already hyperinflated to nothing. So hyperinflation is part of all of this stuff, and that's what's driving all these countries crazy. So I just see the front end and the back end coming together sometime soon, and hopefully saving us from annihilation. That would be nice. I'm not the kind of guy that believes that we're going to annihilate ourselves. I'm much more positive than that, but that's the positive side of hyperinflation. It stops people from killing each other eventually because they run out of money to do so. It's, a morbid thought, but it's true.
Now, when it comes to precious metals, we've obviously seen elevated prices for gold and silver recently. Especially gold has held up quite well as it seems to try to retest that $2,500 level. Your take on the current price action we've been seeing amid all this, geopolitical chaos, especially, but also these concerning developments in the financial system.
Yeah. Well, if you're trading, I wouldn't say, oh, there's going to be a big Middle East war, let's buy gold now. You can get caught doing that. I'm not trying to discourage anyone from stacking. Stacking has nothing to do with this because premiums balance out the spot prices all the time. So if you want to add, if you're planning to add to your stacks, don't let the war stop you, or don't let high prices stop you, because once you have it, you're not really going to trade it that much probably. But if you're trading, I'm not so bullish on the very short term on gold and silver right now. I've seen this before when Iran threatens and says it's going to bomb Israel, and then they make a show and nothing happens. That's what I think is going to happen this time again, for good or for bad, whatever you think about it. There's like 12 U.S. ships already on the way over here that are just there to calm things down. I don't think they're going to take any action. Hopefully they won't. And the reason that, at least technically, that I'm not so bullish in the immediate sense, meaning just like in weeks, maybe a month, about gold, is that open interest is still very high. Meaning there's still a lot of longs and shorts. Each contract is a long and a short, so it's the same number. It's something like 510,000 contracts, and I think we got to get down to like 450,000, something like that, which is pretty low over the last 2 years, in order to start a new rally. And I think this whole war talk is a lot of hype. Or maybe I'm just hopeful because I don't really want to be in a war or get evacuated right now, wherever. So I'm trying to stay positive, and I want to see gold calm down here, which again on the back end would calm down the war rhetoric. And once we get down to 450, I think we'll head for another leg up, maybe to 2,700. Who knows how long or short, but that's all that is. It's peanuts, because one day the dollar's not going to work anymore and gold's going to move to, like, I don't know, 3,000 to 20,000 in a week, something like that. I'm not saying that's going to be the number is going to be a week. I'm saying something like that is going to happen at some point, and by then it'll be too late. You don't want to play with fire like that.
And if our viewers are interested in learning more about your forecasting of the end game, they can go to the End Game Investor on Substack. We'll put a link in the description of this video. Do you want to share with our viewers a bit about that and any last thoughts you had?
Yeah, my Substack is I write there 3 times a week usually, and I put out a free article every once in a while for everybody. And if you want to become a paid subscriber, that would be great. And I try to make it fun. I'm more of a writer than I am a speaker. You can also check out my YouTube channel, Rafi Farber, or my Patreon, where I go into the religious angles around these issues. And the last one I just put up for my Patreon is why fractional reserve is forbidden biblically. And I give a proof for that through the laws of marriage, actually. Check it out there. I try to keep grounded, even though my name is, the End Game Investor, and it sounds kind of hysterical. I don't want to be hysterical, and I'm not being hysterical. I'm just saying, keep this in mind and stay calm. And if you've got what you need, we'll get through it as a species. We'll get through it as a family, as a town, whatever unit that you're in. Just stay safe, stay around like-minded, moral people who know who boys and girls are and everything that comes from there. And you'll be okay.
Fantastic. Well, Rafi, we really appreciate your time today. You have a great weekend and God bless.
Thank you, Elijah. You too.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for July 29th through August 5th, 2024, while supplies last. First, we feature Dealer's Choice Constitutional Silver dimes, quarters, and half dollars at $2.50 over spot per ounce. We also have 1 ounce gold backdated Canadian maples at $65 over spot. Next, we have a limited quantity of 1 ounce silver full color Trump Fight for America bars at $6 over spot. They come 22 a sheet and so have a minimum order of 20. And finally, we have 1 10th-ounce gold backdated American Eagles at $39 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.